So, Jenny, why do you remain extremely cautious on the market?
Because there's still a lot of garbage and difficult times ahead of us. We have the Fed still entering a tightening cycle. I don't know if they'll reduce their balance sheet at the same rate that they were going to 3 weeks ago, but they might. Interest rates are rising. Geopolitically, things are really hard. We've had a spike in commodity prices, which they may come down or they may sustain for a long time. And we have valuations that aren't cheap yet. They're not extreme. I would have said around 22 times valuations were extreme, so now I'm feeling a little better, but I would still say valuations are stretched. This is not a great backdrop for a really terrific, exciting bull market. It's just not. And I think it's messy, and I think it's going to be hard. So I used the word when I was on last week, and I think it's the right word to use. It's treacherous out there, and it will be treacherous for a while. 2022 is going to be a very hard year where there's hard work to be done. I also think that this will be an asynchronous correction. So I don't know, when you asked the question before, Scott, and you said, are we at a bottom and is it time to buy? I think, yeah, it's time to buy, but you don't need to buy broadly. But I don't know that we're at a bottom either. And I think that those things are going to move asynchronously. So there will be stocks all along that you can pick off. As you know, a couple weeks ago, I bought Foot Locker and 3M. Great. The market pulled back and I was able to buy each of those. But I'm not broadly just piling in and saying, hey, the whole market's down. We can add to everything in the portfolio. So this is a time just to be cautious, sit back, be patient. You don't need to throw all your cash in. You can just breathe. One thing that's important, though, is in the very long term, I will always be bullish on equities. I will always believe that over the long term, the equity market will give you a positive return. Well, so if you're fully invested, you don't also need to cash out right now. You can just be patient.
Bryn, somebody's buying because we're positive across the board, and we're at the highs of the day now for stocks. So we've had a little bit of a rebound since we started in the last 8, 9 or so minutes. Now, to the question of, do we have more downside ahead? Are we at a place where we can finally feel comfortable buying some stocks like Stephanie Link is, and some of the others may be as well? There are some notes regarding that today. Steve Suttmeyer, Bank of America, no true capitulation yet. Hasn't seen it. He says that favors more downside. Jonathan Krinsky, whose insights from a technical standpoint we like very much, says we're getting close, but we haven't had a full washout yet. Do we still need that? It's not like you get that every single time. And believe me, we have had some pretty sizable downdrafts. Are we close? Does it feel like we're close?
Yeah, I think you actually do get that. I think we actually have had that 90% downtime every time, except when we had a sell-off in either 98 or 99. So I do think that technicals trump multiples right now. And what I mean by that, and we'll obviously if we hear from Jonathan later, but I think technical analysis to look at where the support level is. For the S&P right now, I think it's around 4,000. We might be closer to 300 for the Qs, which would be representative of the NASDAQ 100. And I own, by the way. And so versus multiples. And when you look historically at current multiples and then project subsequent one-year returns, there's almost no correlation between that. So I'm not focused on whether the multiples are 19, 18, or 17, because it really has no predictive power over the next 1 year. I do think technicals, though, gives you a tradable entry point. And it seems, because we haven't had those big sell-offs, that big down day, that we could have more to come. I do think that midterm and looking out later on this year, where I have pause is that in Europe, the probabilities of Europe going into a recession have definitely ramped up. And as the U.S. has plenty of supply of natural gas, right now in Europe, Scott, natural gas is 13 times higher than in the U.S. Food prices globally are going higher, which hits the most vulnerable of people globally. And so I think GDP was already going to be decelerating because China was slowing down. This adds that in there. Now come back to the U.S. We have higher food prices. That's not going away. We have higher energy prices. That's not going away. And although energy prices compared to the 80s as a percent of U.S. consumers' budget isn't as high as it was, I do think that the market, the consumer is more vulnerable. And whether we have we'll call it a sentiment recession with consumers, or an actual recession. I think that sentiment recession where people just don't feel like spending because they feel very uncomfortable.
Okay.
And then just finally, Scott, there are so many second, third, and fourth and fifth order effects from this Russian invasion of Ukraine. And I don't know if the viewers saw, nickel is traditionally trades at about 20,000 per metric ton. It closed yesterday at 50,000. Last night, nickel was at 100,000. Why is that important? That goes into lithium batteries. That goes into all sorts of green technologies. So then how does that affect Tesla, GM, Ford? And so there's so much to actually to discern through, but I'm still very cautious because I don't think this is a traditional type of event where we cut countries off from the SWIFT system, et cetera. So I would still remain cautious.